podcast with your host Hossein Talib. I have a special guest today, Mark Willis. He's a man on a mission to help you think differently about your money and your economy and your future. Mark is a 3-time #1 best-selling author and the owner of Lake Growth Financial Services. And he's the host of Not Your Average Financial Podcast. Mark, welcome to the grid.
Thank you, Hussein. Glad to be on your show.
Awesome to have you here. So tell us a little bit about yourself. Where were you like 10 years ago or 20 years ago, and where are you now? Because now, as I mentioned, you run financial services company Lake Growth, and you have your own podcast, and you are #1 best-selling author 3 times, which is something that's cool.
It's not easy. I will tell you the secret, though, is making great friends is how you write 3 best-selling books. I was privileged to get to co-author 3 books with wonderful established authors, some of whom have been New York Times best-selling authors. And so when you are co-authoring with them, you really have the opportunity to write on their coattails and to make some sparks fly and have some fun writing wonderful content for their audience, and our audiences grow together. So
cool.
Yeah, our financial firm here in Chicagoland, we work with folks all over the United States, Canada, and around the world, where we meet with people one-on-one and have discussions about where the world is right now, and not just on a macro level, Hussein, but on a micro and personal level. How about you? How about your finances? How about your family? What do you want out of life? Your business? How do we create your own economy that's not dependent on outside forces, where we can influence your future with predictability and guarantees? So that's what we focus on, and I get privileged to work with clients all over the world.
Awesome. Because a lot of things happen in the world sometimes at the same time. They have a big impact on people, or this is what people think. Well, they do have some impact on them, but also people have they could, let's say, the initiative to impact their own future, like you mentioned. So cool. So speaking of your financial services, how can an entrepreneur, like if someone wants to start a business, okay, they don't have money and they want to go and boost this business, they traditionally would go to a bank or a financial services company so that they can get some money to boost their business. So do you have some ideas of someone who does not want to do that and, let's say, bootstrap their business?
Well, the bootstrap model is one that's certainly commendable. It sometimes can take more sweat equity and more time. And the other option is to get equity partners, where you have a business partner with you. I was just speaking with someone here just moments before I got on this call, and he's been a very successful medical professional here in the United States. And he had 3 partners, 1 business partner and 1 silent partner. And the silent partner just passed away. Unfortunately passed away. Yeah. And so they, these 3 people are now 2, but one of the, I guess the surviving spouse of this silent partner who passed away, now she is an unwilling business partner in their business. They don't really, they have friendly relationship with her, but they don't really, she doesn't know the first thing about running a medical practice. They don't really want her there, I'm sure. And so they're kind of forced in. So there's some issues. What I'm saying here is there are some issues with bringing on equity partners without having an exit strategy if something like that should happen. Now, maybe it's someone passing away, or maybe it's just someone deciding to leave the business. I feel like too often, many times, there's just not an exit strategy for our businesses. And Hussein, I guess a philosophy or a belief I have is that we all need an exit strategy for whatever we're doing in our life, because we're going to exit everything ultimately someday in our life, hopefully a long time from now. But whether you exit your business because you sold it to a public company, or you went public yourself and you sold out, or you pass away like this unfortunate situation, whatever your story is, someday we're going to exit that part of our life, and we need a well-written, thoughtful exit strategy to get us there.
Cool.
So that's one of the key, I guess, topics or ideas that we think through is let's think long range. Let's think long range and build something that builds guarantees and predictability into our future. I feel like the business owner has a lot of things in his or her life that are not guaranteed. And so if we want a success in our future, we need something that's guaranteed for us that we can hold on to no matter what the market does or whatever the business might do.
Yeah, cool. Because like you mentioned, any business you're saying, it's like they should be thinking when they start out, they should be thinking about an exit strategy. Because like, for example, even naming the business itself, if you name it under your own name, it's like, I don't know, it will be maybe hard to sell. I don't know. So if you name it something else relative to the thing that you are actually doing, it will be maybe easier to sell and will go a long way in the future, instead of you naming your business your own name. So that's a great
That's right.
idea. Yeah,
Yeah,
exactly.
Yeah, that's just one idea where you don't necessarily want it to be named after you. And I would say there's a number of different strategies and financial concepts that helps give you what I call a golden parachute, where you can leave that business someday with a golden parachute on your back and fly off into the sunset and enjoy a wonderful retirement, or if it's not retirement, it's the next chapter in your life that gives you some sort of assurance for all the risk that we take as business owners. We need some kind of walkaway money to leave that business better off, and our clients or customers better off than we found them.
Yeah. So you yourself in your business, how do you manage debt for your clients, for example? Is all debt bad, or there are some good debt?
Well, there's kind of only a few ways to make major purchases. So we've been talking about bootstrapping. I'm going to call that the pay cash method. Then, of course, there's going into debt to start your business, or bringing on equity partners. That's really the three ways to start a business: get into debt, pay cash and bootstrap, or bring on other outside investors. And so if we're looking at kind of the debt side of this option of this conversation, if we're using traditional banks, credit cards, finance companies to finance our business or our personal life, we have a partner with us. And in fact, they're not just a partner, they're more like a master. When we're in debt to somebody, we are literally their slave, you might say. I hate to say it that bluntly, but we have an obligation to pay them back. And if we don't, they will come and repossess our car, or garnish our bank account. I mean, things get pretty bad pretty quick if you don't pay your debts off.
Yeah.
So what can we do if we don't have a $10 million or whatever to start our dream business? Well, we can pay cash and we can bootstrap, and that can oftentimes take 10 years, 20 years to do. But at least we did it. We pulled ourselves up by our own bootstraps, as the old phrase goes. But there is good kinds of debt. And a lot of your listeners might understand the idea of good debt versus bad debt if they've read anything by Robert Kiyosaki, like Rich Dad, Poor Dad, and other similar books, Hussein. But I'd like to actually suggest something that might kind of be a little counterintuitive. And that is, what if you could become your own debt to yourself? What if you could be your own banker?
How is that possible?
Yeah. Well, let's think about it for a minute. If you are in the financial universe, if you participate in money, and most all of us do, if we're in human civilization, we're in the money game. I'd like to suggest that we're already in the banking business. We're in our day jobs. We're in two businesses, really. We're in the job that brings in the paycheck every month, whether it's whether it's an employee job or whether it's a small business that you're starting. But we're also in the banking business. We're also in the banking business. And what do I mean by that? Well, there's a great book out there written by David Graeber, and the book is called Debt: The First 5,000 Years. And it goes through the history from ancient human civilization right up until today, like this moment. And he just talks about how banking has been a permanent part of human civilization since caveman days, since as long as we've got human history. And so I'd like to, I guess, suggest to you and to your audience that banking will be here as long as it'll outlast all the other major, it's as old as friendship. It's as old as, marriage. Banking is as old as about any other human, interaction with each other. So debt is permanent. The question is, who is your banker? And if you have anybody else working as your banker, they will win over the long run. They have an exit strategy for your business. If your business doesn't do well, they will take it. If it goes really well, then you have to pay them back with interest, and they're going to win. So they win either way, whether your business wins or loses. And that's true on a personal level too. If you have your credit cards and your car loans and your mortgages, the bank will win. This is why banks are the biggest companies in the world, why they have the biggest buildings in town. So what if you could pay yourself a monthly debt payment and recapture all that money that you're currently paying to banks, credit cards, finance companies, mortgage companies, car loan companies? If you could just pay yourself the same interest rates and monthly payments that currently goes to all these other banks, you would win, because you'd win by default. You'd win by default. Why? Because all of your competitors, everybody else in your world, whatever your business is, whether you sell, widgets or tech, or you're a service company, whatever you do, all of your competitors are using banks, or really your competitors are being used by banks, almost like a parasite and a host. The banks are leeching profits off your competitors.
Yeah.
So if you can get out of that and be your own banker, then you would win. In the competitive space between you and your competitors, you would have an advantage. So that's how, that's why it's important to be your own banker. We can talk about how, but that's why it's so crucial, and why, as a certified financial planner, I've made it my mission to tell people that before we go chasing rates of return on Wall Street, just trying to get a little bit higher rate of return, or throwing a little money into Bitcoin or something, that's fine. But more important than that is, who is the one who controls the banking function in your life? We're already in the banking business. We're just sitting on the wrong side of the desk.
So you're basically saying, I guess, maybe the concept of to pay yourself first, maybe, because if someone has certain amount of income a month, for example, to save, this is how it's done, maybe to save some money, like for example $200, $300, $500 a month aside, to count it as it's like some kind of installment for something, and do not touch it for a while, put it in a place, in a bank basically, but does not, it's like a deposit, that cannot be touched for a while.
Yeah. So pay yourself first is another really great strategy and an important philosophy. But I would actually say that pay yourself first is different than bank on yourself. When you bank on yourself, you're paying yourself a loan payment with interest. So let's pretend you and I were in the mortgage business together. You and I start a mortgage company. We want to start this mortgage company. We're loaning money out to people so they can buy their homes. So, okay. So Hussein, let's pretend in this example that I need a house, and I'm going to get a mortgage for my house. Now, I have a question. Would I go, since you and I own this mortgage company together, would I go to any other bank to get my mortgage, or would I come to you?
We own this company, or are you going to take it a mortgage from another bank, or will be inside between us?
Yeah.
Oh, well, if it's the same thing, but if you take it from our company, maybe it will be favorable to you, because I will give you as a partner less fees and less interest on things, right?
Well, maybe you would. I mean, that would be very kind of you, but that wouldn't really help our business, would it?
Yeah, and that
so
it will take a little bit of the business side.
In fact, the more fees and the more interest you charge me, the more profitable our business is, right? And I'm kind of a captive customer. I'm your I'm the best kind of customer, because I can't shop anywhere else. If you had a customer at your business, let's say you sold coffee, okay? Let's say you sold coffee and there was no other coffee shop in town. Couldn't you charge any price you wanted for coffee?
Yeah, basically, yes, you can.
Yeah. So if I have to come to our company to get a mortgage, you better at least charge me a fair interest rate. I don't want you to give me the family discount because I'll end up costing our company a little bit of money, right? Now here's another question: if I stop paying you, are you going to ask me to pay you? Like, not just you, but our company. Like, are you going to expect me to make a payment? Or do I get this for free?
Well, that might be a problem. Like you mentioned earlier, a partner passed away, so that might be a problem if you're not paying. We're cool, we're friends, but you have to pay your payments.
Good. I'm glad to hear that. Good.
Business is business.
Business comes first. I'm with you, and I agree with you. I do the same. So here's my last question: Who benefits from the payments I'm making? Who benefits from the payments I make?
I guess the business itself, or eventually us both. So it's like a circle.
It's like a circle. Yeah. So don't I, in a sort of an indirect way, don't I benefit from the payments I'm making to a mortgage company you and I own together?
Well, basically, some of the money might be back to you, I guess.
Yeah. A part of that would come back to me, and of course, go to you. And the point is, I'd be in control. You'd be in control. We would have control over the banking function in life. Now, multiply that out through student loans, car loans, and okay, that's a cool thought idea, but how do we actually do it?
Yeah.
So I use for our clients a very specialized form of whole life insurance that lets us act like bankers, just like I described. We use a mutual life insurance company. It's a mutually owned life insurance company. Hussein, it's kind of like if you and I mutually own a mortgage company. In this case, it happens to be a life insurance company of all things. So we can use the policies that are at that company and borrow against them. So there's this function where we can access the money in the life insurance policy and borrow against it like a bank. It's not like a bank you'd see on the street corner in town, but it's like a bank, and I can borrow against that life insurance. And then I get to repay that at any pace I wish. I can choose to skip a payment or pay $100 a month or $500 a month, whatever I choose. So I'm in control as the banker.
Maybe it's like some people who take loans based on their credit cards. If that's allowed in some banks, I guess, maybe not all. Or some people who have like a loan and a deposit, which is this one gets credit interest and this one gets a debit interest. So if that's higher than the other, you can take a loan, especially if you have, like, for example, a $1 million deposit box, and that's giving you 6%, for example, a year, and that's you have a loan for 5% a year. So there's a 1% difference.
Yep. That's right. That's right. Yeah, and in fact, that's exactly what you're describing. There is something called arbitrage. That's the the vocabulary word there, but the key concept is powerful, because you have in that safety deposit box, or in my case, a whole life insurance policy, it's uninterrupted compound growth, which is very rare to find in the universe. Whole life insurance grows guaranteed every year, compounding, becoming more valuable every year we keep it. And you're right. If I borrow against the life insurance, there's some interest that's charged, just like you'd charge me a little interest at the mortgage company that we talked about. But my policy is growing faster than any interest I'm paying on a policy loan. So there's arbitrage there. We have a powerful tool, and our clients have a powerful tool, and use this like a bank that they own, and can use it for their cars, for their vacations, for their businesses' needs, big, large capital expenses, maybe some inventory for their business. I've had a guy just buy a large X-ray machine for his medical practice. You can use it to send your children to college. I mean, the list kind of goes on and on and on, Hussein. But the key principle is reclaiming that banking function in our life so that we can control that part of our life rather than letting someone else control it. for us.
Yeah, cool. But just to mention, I think I still work in a bank, so I kind of. But the funny thing, to tell you this a little story, at the interview where they hired me, they asked me why, like they always ask this question, why do you work here? You know, so I don't know. The day before, I read this some quote from German philosopher. I don't know who he was, but basically it said mainly like banks are not good for the world. This is what was the quote around. So I told him that who interviewed me, like I don't really believe in banks. I just wanted a job right now.
Yeah.
This is what this basically. The second day they called me, you're hired. So that was weird. But
yeah.
but I don't know, maybe
Right.
because I was opposite of things to them. So yeah.
Well, I'd love to know who that philosopher was. That sounds kind of interesting. I'll
Yeah,
tell you.
I will hope. I will check it out. Hopefully.
Well, I think you're right. I think banks are the problem, but banking is the solution. So I'll say that again.
Yeah.
Banks are the problem, but banking, personal banking on the you and me level is the solution.
Mm.
If even just 10% of the world could have their own banking in-house, like in their family, like the Hussein Taleb family bank,
Yeah.
where all of a sudden now you've got the vast majority of the major purchases of your life are happening within the you and me level, then what would happen to the banks in this world if 10% of us didn't need them
Exactly. Yes, this is a great idea, because in the same family you see people who are their economics are not so good. Some of them are good. So instead of someone who's, for example, not so good in the family, they want to go buy a car, for example, and they take a loan from a bank. Why not take it from someone who's inside their family? And if it's a good person, to me, if someone wants to take money from me, pay them back as much as you took. So if you took 1,000, give me back 1,000. I don't because I am basically not in general, generally speaking, I'm not a bank. We're like family, give it back to me as much as they are. But if you want to make a little bit, let's put for example 2% on it. So
sure, yeah.
So that will be inside of this circle that we talked about, instead of taking that money to a bank and taking, I don't know, 6, 7, 8, 10% off, and you keep years paying for it.
I love it. Well, Hussein, and you get to decide as the banker what you charge, if anything. I'll tell you two very quick stories. One is just an average client of mine, wonderful man. He's a photographer, so he doesn't make $1 million a year doing his photography business. And he started one of these whole life policies. We call them bank on yourself type whole life policies. So one of these bank on yourself type whole life policies, he started them at just a couple $100 a month. And he started saving in it, and he started borrowing from that to cover his film and photography equipment. Rather than using a credit card and paying some other bank, he's now using that money in his policy and banking on himself. That's the idea. But here's where things get interesting, because he's showing off his new camera, and his competitors, his colleague photographers, are saying, hey, where'd you get that? How'd you buy that? And he says, oh, I used my bank. I used my personal bank to buy this. And they're like, your personal bank? What are you talking about? And then they say, well, hey, I need to borrow some money for my new camera. So he's the bank for others as well. His competitors are coming to him. His photographer competitors are coming to him for money. So like I said before, you're already in the banking business. You're just sitting on the wrong side of the desk. He moved to the right side of the desk. He's now the banker for himself, but he's also helping other people get their photography equipment. And even though they might be his competitors, they are paying him for those, new lenses and cameras and everything else. So that's just one story. And I'll share just one other very quick story. There was a gentleman who had some health issues, and he could not be the insured, because life insurance requires a medical exam here in the United States, probably most places. And so he had an open heart surgery and could not get a policy on himself, but he got a policy on his wife and his 3 adult children and all of his grandchildren. So he's got like 12 policies that he owns all together, and he is the owner of those policies. He controls the policies. And about once a year, he gets the whole family together at Thanksgiving, and he'll have a conversation with them about what all the policies are doing. He'll say, hey family, here's the family bank. Here's the 12 policies we all have. And if you need any money, kids, don't go to the bank down the street, come to the family bank. And we'll get you that car loan. We'll pay off your student loans. And guess what? When they pay him back, who are they benefiting? Well, the family.
Yeah.
Someday when he passes away, that's money that they get to inherit again. And guess what? They're going to go put that into new policies.
Yeah.
And so the cycle continues. This is how generational wealth is created.
Yeah. So we're talking about here, like a lot of people have big problems dealing with their own finances.
Mhm.
So how anyone like the average Joe or anyone can improve their finances and without taking the risks?
Mm-hmm. Yeah. Again, if you control the environment where your money lives, you have removed unnecessary risk. If someone else controls the environment where your money lives, there's going to be unnecessary risk. And, Hussein, this, starting a business, heck, just walking out the door, getting in your car or whatever, that takes risk just to go outside these days, especially. So I don't want to avoid risk. In the risk is the potential for reward. Now, risk and reward are not the same thing. I think in the United States, especially, we've become a nation of speculators, and we think that that risk equals reward, and that is not true. Risk is the possibility of loss. That's what risk means. So if we want to take risk, we have to realize that we potentially could lose. So I don't want to take unnecessary risk. That's kind of my personal philosophy. I don't want to take unnecessary risk. I'm happy with risk. I'm a business owner too. And I love the thrill of like going on a zip line or, taking a water boat ski, whatever, outside. But unnecessary risk is something we stopped doing after college. Once you starting a business, you don't want unnecessary risks in your business.
Yeah.
So how can you do it? You can control the environment where your money lives. I'll tell you that banks, and I hate to be a hater on banks since you work at one, but a bank will tell you what to do with your money, and then they'll go and do something completely different. I'll tell you a statistic. According to the FDIC Insurance, which is a corporation here in the United States, Bank of America has $22 billion in cash value life insurance. $22 billion in cash value life insurance. Some of these bank on yourself type policies I'm describing is life insurance. So they have $22 billion in cash value in life insurance. That is worth more to them. It's valued higher than all of their bank branches, all their real estate, and their downtown Manhattan, New York City building combined.
Whoa.
So they've got, what are they doing with so much cash value life insurance? And it's part of their tier 1 capital. Okay. That's just Bank of America. Talk about Chase Bank and Wells Fargo and
Citibank.
All the Citibank. Yeah. I've got a full list of all the major banks and how much money. It's hundreds of billions of dollars in cash value life insurance. So my question is, why do banks tell us to put money in savings accounts and CDs and money market accounts, and then with their own money, they go put money into life insurance? What do they know that we don't? And so my philosophy is, don't do what banks tell you to do with your money. Watch what they go do with their money and then do that instead.
Well, that's good. That's powerful. But what happened in the real estate market, I guess, in the States, which affected the global market in 2008, and the banks? I watched the movie The Big Short like a while back, and it's when you at that situation, like the movie, when you bet against the market that's going to go down, which was the real estate market, which is, most people say, like it's a market that won't be down, let's say. So some people, yeah, know certain things and profit from the people who are putting money, like in the movie, some people who lost their pensions and 401k and these kind of things. So basically, always the money transferring to people who has the money already.
Yeah. Well, you're right. I think somebody once said, I need to go find out who wrote this, but they said if you took all the money in the world and then spread it out evenly to every person, if everyone got the exact same amount of money, they said that within about 30 years or so, it would all be bundled up again among kind of the top 10% and then the other 90%. I don't know if that's true or not, but that makes sense. That makes sense.
Yeah.
Because some people are willing to lose their money for today. They would rather spend. There's a quote by Gloria Steinem. She says, "Rich people plan for generations, and poor people plan for Saturday night." And I think that's how we lose wealth. That's why the rich get richer and why the poor get poorer. Part of the reason why, maybe not the whole reason, but I think it's at least a part of the reason is we have short-term thinkers and we have long-term thinkers. And Hussein, I think the people who listen to your podcast are wanting a better future. That's why they're listening to a podcast and not, just listening to music or whatever all the time. They're trying to be a better version of themselves. The show is called The Success Grid, for goodness sakes. So you're wanting a better, bigger future, and that's awesome. So if you have an audience that's wanting a better, bigger future, then they're going to be a part of that smaller group of people that think long range. Exactly. Not just for Saturday night.
Yeah, well, that's like we mentioned earlier. It's like people. As soon as they get their money, they want to spend it. They want to hang out. They want to watch a movie. These kind of things, and that's cool. That's okay. But if someone looks at themselves like 10 years or 15 or 20 years from now, if they are like 20 or 30, so that would be the same thing again and again and again. You need to do better than that, I guess.
Yeah.
Unless your mindset is like you're good where you are, that's something different, and that's the problem. Some people are, let's say, comfortable with where they are. Yeah, right.
And I'm not here to tell folks how to live. That's not my. Some people are mosquitoes, and some people are grasshoppers. There's mosquitoes that fly to the bug zapper and just go out in a blaze of glory. Zap, and they're gone. That's a wonderful, beautiful spark of brilliance for about a split second. And the others are the grasshoppers that are chomping on grass, as boring as it looks, but they live for years and years and years, and they reproduce. So I really hope that whatever little bit of insight folks get from this show, it's to think long range. I had a tree fall in my yard. We had some big storms this last week here.
Ooh.
And so I had a arborist, a tree guy, come out and talk to me about what to do with this tree. And he's one of those guys, Hussein, who just he loves what he does, and you can tell he loves trees. He was like holding the tree, almost like giving it a nice hug. He was showing me these little spots, and here's the little mushroom that you need to watch out for. But one thing he really emphasized was, he looked at me, he kind of saw how old I was. He kind of saw my daughter playing in the back. And he's like, Mark, you're probably going to be here a long time. You might have grandkids here. We need to do this, 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 and this to help get you ready for the next 50 years. And these trees are going to be here for the next 100 years. And so he helped me think long range. And I think a good financial advisor, they're not just trying to chase this week's rate of return. They're not just chasing this week's headlines. They're wanting you to think long range. And like with our work we do with clients, I don't just think about the taxes that you're going to pay this year.
Cool.
But I think about how much you're going to pay over your lifetime in taxes, and even your kids, and how can we minimize that so that you can keep more of the hard work you've set out to keep.
Cool. So you personally, speaking of taxes and these kind of things, and like 50 years ahead, so how do you personally work with your clients to make them, for example, do certain investments or certain things to be wealthier with time, And what the second question is would be like, what are the things that would make them pay less taxes? Because paying less taxes, a lot of talk about people who are wealthier, like Jeff Bezos and other people who are like billions of dollars, talking about like they pay less taxes. So how do you do that? Is that possible?
Warren Buffett, Jeff Bezos, Elon Musk, the Carl Icahn. There was a recent publication in the news cycle here by ProPublica, which is an independent news report agency. They investigate. I guess they found the IRS. Someone at the Treasury Department illegally leaked all these people's tax returns. All these very wealthy, public individuals' tax returns. I mean, imagine if that was your, tax return. So here in the United States, it's illegal to kind of share that information publicly, but here it is. It's public. It's in the world for all of us to see. And you're right. Jeff Bezos he has a number of years where he paid no taxes. Mark Zuckerberg, who started Facebook, multiple years where he paid no taxes. And it's very interesting. I read the report, I dug into the details, and they very similarly use all the legal means they can to pay no taxes, both now and in the future. But they had to buy in to this club. They had to buy their ticket. They paid a lot of taxes. Mark Zuckerberg in 2013, he paid over $1 billion in taxes in that year alone, the report says. So here's something that I'll share. It's called the buy, borrow, die strategy. Buy, borrow, die. So BUY.
Okay.
And then BORROW, and then DIE. So it's buy, borrow, die. Does that make sense so far?
But I think one of the strategies, like maybe like some countries, I guess they make some people open businesses without taxes. So this might be one of them. Just a note. I think this is what.
Well, the business itself might pay no taxes, but how do individuals like live your life? So anytime and every country is going to have a different, tax law, but I noticed these are the same around the world. So the first step in the buy, borrow, die strategy is to buy assets that don't pay you an income. So it has to be that, because if you get paid an income, like let's say you get a rental property, very popular for folks to want to do real estate investing. But if you get a asset like a rental property and it starts paying you rent, eventually you have to pay taxes on that rent. Now here in the United States, there's things like depreciation costs and some other strategies to lower your taxes, but that's a taxable stream of income. That rent money will eventually become taxable to you. So we have to find assets that don't pay income. This is why Warren Buffett and his company, Berkshire Hathaway, has not paid a dividend since 1965. There's a reason why.
They don't dividend. You mean dividend to the shareholders? You mean?
Yeah.
Really?
Yeah. Look it up. So there's no income that comes when you own a share of Berkshire Hathaway. They don't pay a dividend. As profitable as they are intentionally not paying dividends, I think, because Warren Buffett would have paid billions of dollars in taxes over these many years if they've been paying dividends to him and all the shares of stock he owns. So that's the first step, is to buy an asset. And this is straight out of the ProPublica report. Buy assets that you don't see an income on. And this might relate back to our bank on yourself strategy I mentioned earlier. So hold tight with me. The second step in the buy, borrow, die is to borrow. So if you borrow against that asset that you just bought, like Mark Zuckerberg in 2013, he paid that $1 billion of taxes. What did he do? He bought a bunch of shares of Facebook. And he bought in, he paid his ticket to be a part of the super wealthy. And now he borrows against his Facebook shares to live. Because, if you just buy a bunch of, assets, how are you going to buy your groceries? How are you going to buy your yacht, your second yacht, your luxurious lifestyle? So you got to borrow against all these assets. And Hussein, the interesting thing is when you get a loan, it's not considered income. And therefore it's not taxable.
It's a liability. It's a liability.
Yeah. It's so if it's not a income, it's a liability, and so you never have to pay a tax on a debt. And so they're able to live on their their borrowed money. This is how Donald Trump did it. You know, he has a ton of debt because he lives on all that money, and he has all these real estate deals. So it's all the super wealthy. They all do the same thing. It's all completely legal. But the key is the gotcha that most tax systems have is when you die, you're supposed to pay a big estate tax. And so dying is an interesting tax avoidance strategy for the uber wealthy. And what they do is they actually have either a trust or they have other means to have what's called a step up in basis, where all your assets become more valuable when you die. Here in the United States, if I bought a house for $100,000, $100,000, and then let's say it grows to $1 million over my lifetime, and then I die and leave it to my children, it would be worth $1 million to them, and they would not have to pay a tax. So that's the last step in the buy, borrow, die strategy. Now, first of all, I want to kind of talk about how us normal people could do this. But do you have any questions over the buy, borrow, die?
Yeah, it's like they're basically using debt or borrowing to go around things, because like we mentioned, for example, taking a loan is basically a liability, so you can be taxed on that. Or like you mentioned, an asset that does not bring any income. So and you mentioned real estate. Like real estate brings you rent and you have to pay for that. But what are their assets that does not bring income?
Shares of stock that are not paying a dividend, that would be one.
Like Warren Buffett,
like Warren Buffett. Yep. Artwork, gold, things that don't produce an income. Life insurance is an interesting one. So this is where, like, average folks like you and me, I can buy a life insurance policy. It's an asset. You know, if it's term insurance is just a death benefit, and that's not really, you can't use the buy, borrow, die strategy with term insurance. Most people think about life insurance and they think about term insurance. Term insurance is just the money you leave your family if you die. You're just renting life insurance, which is fine. You know, just like renting an apartment, there's nothing wrong with renting an apartment. But if you're going to own a house, you're going to eventually start to build up an asset. It's called equity in the house, right? Your equity in the house is the amount of the house that you own as you pay down mortgage. That's kind of how you own the house. And with whole life insurance, this bank on yourself designed whole life insurance, you're building an asset that does not produce income. In fact, there's a lot of really cool pieces here that I'll just skip right over, but just imagine you've got this building guaranteed to grow for you asset. For the rest of your life, it grows guaranteed according to the insurance company, Hussein. Not even Mark Zuckerberg's stock is guaranteed to grow. You know, Facebook can go down. In fact, it has. So with these whole life policies that consistently and continually grow guaranteed.
Yeah, that's great.
But it doesn't pay an income.
Well, that's very devil-like, I guess. It's not like smart. It's like a devil.
Well, and then as I mentioned earlier, you can borrow against life insurance. We talked about how you could bank on yourself and become your own source of financing for your cars. But just like that, you can buy, borrow, die with life insurance. You can borrow against the asset, and it's all tax-free when you borrow against life insurance. And then when you pass away, you avoid the income tax, because that death benefit is income tax-free. Here in the United States, the death benefit, which might be $1 million, $10 million, you know, whatever your death benefit is, it's all left to the family tax-free. So it's a great way for folks to try out buy, borrow, die before they become the next Elon Musk.
Yeah, because you see these big guys that they move very fast, like from Elon Musk, from I guess PayPal he started, and then he sold, and then he went to Tesla, I think, and I think I read that he didn't found Tesla, he bought Tesla, right? So so he did not really find Tesla, and then now he's basically into space. So and now with Richard Branson into space and Bezos into space, they are going really at rocket speed, basically. So these are really cool tips you shared here right now. So what would you say one takeaway from this episode?
Well, if I could just say one thing, banking is already in your life. From even if you pay cash for things, you're still in the banking business, if you paid cash and had no debt, I'd feel sorry for you because you'd be stealing from your future when you pay cash for things. Think of it this way, at least when you're borrowing from someone else's bank, at least you're an honest banker with who you have a debt to. But when you pay cash for something, you're stealing from your future. If I paid $30,000 for a car, I would think, okay, I've spent $30,000. But the reality here, Hussein, is I lost 30 grand and whatever that $30,000 might have grown to had I not bought the car.
Yeah, exactly. Because especially the car is an asset that is going to depreciate. The moment you buy it, it's going to be 25,000.
Yes, that's right. That's right. And let's say my $30,000 had been left alone, and let's say I just rode in your car for the rest of my life, and you let me ride in the passenger seat my entire life. What would $30,000 grow to over my lifetime if I could keep it invested at, let's say, 5% a year? I'm doing the math here for the next 60 years.
Oh.
What would $30,000 grow to? Do you want to know?
I don't know, maybe 50 million.
Well, not quite, but you're in the right ballpark. $560,000 for one car.
Oh, okay.
So when I pay $30,000 for a car today, I'm losing over my lifetime $560,000. I would rather finance that car with my Bank on Yourself policy, borrow from myself, and keep that compound growth happening. So my takeaway from the episode today is bank on yourself. Don't pay cash and don't use another person's bank, even worse, to finance your major purchases. You can control the banking function in your life.
Cool. Awesome. So Mark, where can people get in touch with you?
If you'd like to hear more about this, you can go to my podcast. It's notyouraverageFinancialPodcast.com. That's notyouraverageFinancialPodcast.com. If you want to meet up with me and have a conversation with me, I'd be happy to meet with you. You can request a meeting by going to bit.ly/learnboy. That's bit.ly/learnboy.
Okay, awesome. Well, thank you very much, Mark, for being here today with me on this episode of the Success Grid podcast.
My pleasure. Thank you.